Hello everyone. So welcome back. In this video, we are going to continue about the latest updates based on 50th GST Council Meeting recommendations. So today we are going to talk about Circular 199, which is on ISD and cross charging. So what is, how the framework of this particular video is going to be? We are not directly going to jump into the circular clarifications. We are going to start with the fundamentals. We are going to start with the basics. So let's start with what is distinct person, what is input service distribution mechanism ISD, and what is cross charging, what are all the basic provisions behind, and the need for this circular or the background behind this circular, and what are all the clarifications which are provided in the circular. And then based on these clarifications, what is that we are going to infer and how we are going to analyze or understand the circular, and then what is still missing in the circular and what exactly should be the action point. So let's start with basics and let's also end with better interpretations, analysis and conclusions as well. So that is how the sequence of this particular video is going to be. On those lines, we have also created chapter wise segregation of this particular video based on the time frame. So you can probably, if you think you already know all the basics, all the fundamentals of what is cross charging ISD and all those stuff, you can directly move on to understand what is given in the circular. If you have already read through the circular, you can even directly get to the last conclusions, inferences and analysis, right? So we have tried to make that segregation, and I think that would be helpful while watching these kind of videos which are otherwise a bit lengthy. Okay. So on these lines, let's get into the topic. So let's start with the basics. As we said, if we have to understand ISD or cross charging, even before that we need to understand what is distinct person. So distinct person is a concept which has been clearly explained in section 25. So section 25, there is a point wherein they say exactly this. So section 25 subsection 5 on this distinct person, I am just reading what is exactly given here. Where a person who has obtained or is required to obtain registration in a state or union territory in respect of an establishment has an establishment in another state or union territory, then such establishments shall be treated as establishments of distinct person for the purpose of this act. To keep it very simple, under a same PAN of the income tax, with the same PAN, as in the same legal entity, if the entity has got multiple registrations, then those registrations, between those registrations, they are called as distinct person. So it can even be, within the same state or in the different state as well. So the point here is there should be more than one registration under the same PAN, and then when the registration between these two registrations is what they call as distinct person, right? With that in the background, what is an ISD mechanism? ISD mechanism is not something new in GST law. It was even there in the service tax law as well. So what really happens is, let's say for example, internet service provider, or let's say, security services, or let's say, software services. So there are a lot of services which head office will directly, have a centralized billing, but they will instruct the third party vendor to directly provide the services in the respective registrations across India in various states. So what will happen here is that the third party is directly providing services to the respective registration, whereas for all the billing purposes, there is a centralized billing that happens only in the head office. So on these lines, the consumption happens in one state, whereas the receipt of credit happens in another state. So to evenize this particular uneven way of having the credit accumulation, and also to make sure that GST being the destination based tax, there should be a transfer of credit from this receiving end, because the credit has to get ultimately it has to move to the state where the consumption happens, right? So GST is a destination based tax. On those lines, the tax has to move along with the goods or services as well. So that is the underlying concept of this entire ISD and cross charging, in fact. So on those lines, what happens is that in this particular circular, as well as whether you refer to any of the articles or any of the write-ups on these kind of topics, you will invariably figure out that they would have mentioned this example of head office distributing the credit to the branch office, head office giving services to the branch office. Let us understand, the act does not talk anything about head office or branch office. It's only that in a real scenario, most of the time these kind of credit accumulation or the credit centralized receipt of credit or the centralized billing or the internally generated services, all these things will usually happen only from the head office. So that has been taken only as an example. So let's not understand, or let's not always look at it only from the perspective of head office. We need to probably understand it from the perspective of any state to another state, between any distinct persons. So this is one thing that I just wanted to clarify. So on these lines, so section 20 clearly states about this input service mechanism, right, along with rule 39. Rule 39 is giving the manner in which the distribution should happen, and section 24 is also specifying that an ISD should obtain compulsory registration. So all these provisions have been touched upon in this circular as well. Now coming to cross charging, the next part of it. So the term cross charging is an absolutely a commonly used terminology, but in the entire law you will not anywhere find this term called as cross charging. Cross charging is not at all a word that has been used in the law. So what is the base for it? If you refer schedule 1, schedule 1 talks about activities which are considered to be supply even without consideration, which means deemed supply. So there under the second para, they have specifically mentioned that the transaction that happens between related person or distinct person, even if it happens without consideration for goods, services or both, then that will be deemed to be supply, irrespective of there being a consideration or not. So again, as I said, the reason behind is that the tax has to move along with the goods and services in a destination based tax, especially in a federal structure like India. It's very important because only then the recipient state is where, ultimately where the consumption happens, that is the state where the tax gets settled, right? Until then the credit is just flowing, so which means every state is just receiving and then giving back the credit. So the ultimate consumption happens in a particular state, and that is the state which is going to receive this tax as revenue. So if the tax has to keep flowing, it is very important that the supply should also has to keep flowing along with the goods and services. With this concept only, this deeming fiction has been provided. So this is exactly the background of this cross charging. Now having said that, since there is no consideration at all, how do I determine what is the value based on which the tax has to be paid? So that is when section 15 comes into the picture, valuation mechanism, wherein specifically under rule 28, valuation mechanism has been prescribed for distinct person or related party. So these rules has also been touched upon in this circular, right? So with this basic understanding, let us get in further as to what has been explained in this particular circular. So there are three major clarifications which are provided in the circular. Point number 1. Question arises as to whether ISD is a mandatory procedure or not, whether the ISD related compliances are mandatory or not. The circular is completely beneficial on these lines. The circular says no, it's not mandatory. After 6 years of GST, the CBIC has come out and they said ISD is not at all a mandatory mechanism, it's an optional mechanism. In fact, if you read section 20, which prescribes about this ISD mechanism, it also says that the credit shall be distributed, which means they are having a mandatory provision there. And also, if you read section 24, what is section 24? It's on the registration. Registration has got 3 major provisions. Section 22, which talks about the registration based on turnover threshold. Section 23, which gives exemption, which means even if you have crossed the threshold limit also, you're still not required to take the registration. Section 24 talks about compulsory registration, which means even if your threshold, even if your turnover has not exceeded the 20 lakhs or 40 lakhs, still you need to mandatorily get the registration done. That is what is provided in section 24. Under clause 8 of section 24, they are specifically mentioning that ISD should get mandatory registration. So in spite of all these things, CBIC has come out with a circular to say that ISD is not a mandatory mechanism. So let's not get in further on, whether it is aligned with the law or not, for the simple reason that circular is not something which is mandatory for the taxpayer to follow. Circular is mandatory only for the department officials, right? So on those lines, as long as it's a beneficial circular, as long as the circular is only trying to say that it's okay if it's not mandatory, it's okay if it's not being complied with, why should a taxpayer be concerned that the circular is not aligned with the law, right? It's only a beneficial circular. So on those lines, I would say we have to just look into the merits of the circular and move on rather than trying to understand whether it is conflicting with the law or not, right? So what in fact the circular clearly states that, of course, yes, section 24 says that there is a compulsory registration, but then in case the head office distributes or wishes to distribute the ITC to the branch office, only if they wish to do that, then the ISD registration is mandatory. It is not that you should mandatorily take the registration and you should mandatorily do the distribution. So that is what the circular has explained. So on those lines, it's a welcoming clarification what they have provided. So point number 2, second issue what they are trying to clarify is that whether the cross charging is mandatory or not, right? So as I explained, the circular uses this terminology called as internally generated services. They do not use this cross charging. They are saying internally generated services, meaning what? The services which are not probably directly provided by the third party, but rather it is being internally generated and provided by one particular distinct person to another distinct person. Let's say head office to branch office. So what this clarification number 2 says is that as long as the recipient is eligible for full input tax credit, the cross charging is not mandatory. So let's understand why it is so. As I said, the valuation mechanism has been prescribed in Rule 28. So Rule 28, it starts with saying that in the case of this related party or this kind of distinct person, the value should be at open market value, right? So it's just like how you have this arm's length transaction under income tax or whatever it is. So it starts with saying that it should be at open market value, but then it concludes with a second proviso stating that if the recipient is eligible for full ITC, then whatever is the value that is being declared in the invoice, let that be the open market value. That is deemed to be the open market value. So the circular has been extremely magnanimous in clarifying that even if you say it is nil value, it is still accepted to be the open market value. So which means what? It's okay even if you don't do the cross charging at all, because the recipient is anyway eligible for full credit. So the important point here is that the recipient should be eligible for full ITC. If the recipient is eligible for full ITC, then whatever be the value for which you are doing the cross charging, it is fine. In fact, if you don't do the cross charging also, it is fine, because here in that case the value is nothing but 0, right? So to that extent, the circular is magnanimous in clarifying this. So the third point, that is point number 3, which has been clarified here, is that let me give you a contextual understanding of why this issue itself has come. Is that there is one advance ruling way back in 2018 itself on Columbia Asia Hospitals Private Limited in Karnataka. So what happened here is that there are 2 registrations in 2 different states. There is one head office which is providing all these accounting services or administrative services or IT related system services. All these services are being provided by one particular branch in a state to another branch in another state. So this is in fact a hospital, right? So what happens is that because it's healthcare sector, they are not eligible for full ITC also. It's being exempted. The supply is being exempted, so they are not eligible for the ITC as well. So the advance ruling goes on to say that on these kind of accounting or administrative or IT support related services which are provided by one branch to another branch, also there should be a cross charging. So where is the issue here? The point here is because who is providing all these accounting services or administrative, whatever, all these support services? It is only the employees who are providing the services. As far as the employees are concerned, whether I provide to state A or state B or state C doesn't really matter, because everything comes under the same pan. I am ultimately providing services to my employer in the course of my employment, right? So unfortunately what happens here is that there is a conflict. Schedule 1 says that if it is distinct person, services are being provided, there is a deemed supply, irrespective of the consideration. Schedule 3, it states that if the services or if in the case of supply by the employee to the employer in the course of furtherance of employment, basically under the employment contract, then there is no supply at all, right? So these two are conflicting, right? Here the problem is the employees who are physically located in one state are providing services to the employer to another state, towards the branch of another state, right? So here, do we look at it as distinct person transaction, or should we look at it as employer-employee transaction, right? So on these lines, the advance ruling was not favorable. The advance ruling, they said, doesn't matter, whether you have employee or employer, all these things doesn't matter, because here it is a transaction between the distinct person. So it's covered under Schedule 1. You should mandatorily do cross-charging. So because of these kind of advance ruling, in fact, by and large, many corporates have been doing cross-charging, irrespective of course, taking cushion under Rule 28 valuation mechanism. At least cross-charging was being made, right? So again, this circular has been beautifully framed, wherein they are categorically saying that irrespective of whether the recipient is eligible for full ITC or not, even in a case where the recipient is not having the full ITC, still, as long as the employment cost is concerned, as long as the services are being provided by the employee to the employer, whether it is in the same state or between the distinct person also, it doesn't matter. Ultimately, this is not subject to tax, which means you don't need to do a cross-charging for these internally generated services where the employment cost is concerned, right? So this is again, as I said, irrespective of whether the full ITC is eligible or not. So this is the third clarification. So these are the three major clarifications which are provided by the circular. So a quick recap. Point number 1, ISD mechanism is not mandatory, it is only optional. Cross-charging is not mandatory if the recipient is eligible for full ITC. Point number 3 is that, the clarification number 3 is that as far as this salary cost is concerned, salary of employees is concerned, whether the recipient is eligible for full ITC or not doesn't really matter. It is the employee cost, the salary cost need not be cross-charged. So these are the three important clarifications which are provided, beautifully framed circular, right? Now let's come to the next part. What is the conclusion, or rather what is the inference? We discussed about what is not mandatory, right? Okay, then what is mandatory? What is that I need to do? Okay, I understand this is not mandatory, this is not mandatory, and then all these things are not required at all. So what does it mean? Can I completely surrender my ISD registration, or can I completely stop cross-charging from now onwards? Is that the inference? Let's understand then what is mandatory. See here, the point is, as far as the third-party services are concerned, ISD is not mandatory. But when it comes to this cross-charging, it is not mandatory only if the recipient is not having full ITC. Sorry, if the recipient is having full ITC. But if the recipient branch is not having full ITC, then the cross-charging, that is the charging towards the internally generated services, is mandatory, excluding the employee cost. Now, how can one understand this in a real scenario? First thing, even though the circular has beautifully clarified all these things, I really wish the circular has also clarified what is full ITC. Because this is still, something that has nowhere been defined in the law. Even the rule does not explain what is full ITC, right? So how do one normally can understand what is full ITC? Which means, if you are completely having whatever is the credit which one is receiving through a particular tax invoice or a particular supply, if the credit is completely being availed without it being subject to any kind of blockage or reversal, then you can call it as a full credit. So which means what, if at all your outward supply is exempted, then you are not eligible to take the credit. Let us say you have one of those outward supply which is exempted, then you are subject to proportionate reversal under Rule 42-43. Or let us say it is a blocked credit from the recipient perspective, then again it is not a full ITC. Or let us say, it is not an exemption, but there is a rate partial exemption. Let's say, a restaurant having 5% outward GST, wherein they are not allowed to take the ITC, right? So there can be instances where the full credit is not eligible. So let us understand, in all these scenarios, there is a possibility that the department may understand that the recipient is not eligible for full ITC. The problem here is, should we look at it for the particular supply, whether full credit is there or not, or even if there is a partial reversal due to Rule 42-43, should I consider that then full ITC is not eligible? So these kind of matters, I wish the circular could also have clarified, but the circular failed to clarify that. Probably they are wanting to keep it open-ended. We do not know. Okay, so coming back, the circular says that if the full credit is not available for the recipient, then to the extent of the third party services, not for the employee cost, to the extent of the third party services which are directly provided to the recipient distinct person, or which are being commonly provided between the recipient distinct service as well as this head office, however way it is. So on these kind of circumstances, you still have to do a cross charging so as to ensure that, see, the concept is very simple. Had the billing directly happened to the distinct person, he would not have enjoyed full credit. There is a cost element for him, right? So which means what is not eligible for the actual recipient as a full ITC, that should not be indirectly availed by some other branch as full ITC. So which means the mechanism should happen in such a way that there is no excess availment of ITC ultimately. So on these lines, there would still be a scenario where, when it comes to the third party services, where the recipient, the ultimate recipient distinct person is not eligible for full ITC, then wherever the credit is being initially availed, there should be a mechanism to transfer the credit. Whether you do it through ISD or not is optional. So wherever you are not opting for ISD, then it has to be done through cross charging. This is one action point. Action point number 2. Let us also imagine a scenario where employees are not involved in providing the services. Let's say it's an internally generated services. For example, head office would have probably developed some app for accounting, or let's say for ERP, or let us say for any of the software management, any of the management of any kind of activities in the organization. There could be a centralized automated services, right? So how we are seeing in OADER services, something very similar to it, where without any human intervention, or there may be services which are automatically being provided by the head office to the branch office. Okay, so but again, can we call that there is absolutely no component for the employees at all? Because ultimately these kind of one time setting up of these kind of automated services also would have involved some kind of employee role, isn't it? So, but we do not know how the department is probably going to look at it, because there is no direct employee cost which is related in terms of providing the services continuously. Maybe it could have been a one-time setup cost, but in terms of providing continuous services, there is no element of employee cost which is being involved in it. So this is something that they may probably look at it as internally generated services without having employee cost. On those lines, there could be a requirement for cross-charging mechanism as well. So this is something that we can also visualize. So having said that, one more point which I want to touch upon is that, let's understand, ISD could be optional, which means right now you have the option of probably going for ISD or cross-charging. But what is the key important difference between these two things is that under ISD mechanism, whatever credit that has been received, verbatim the same credit has to get transferred to the receiving branch, the actual recipient. Which means what? You receive it at 5%, you receive it at 12%, 18, 20, it doesn't really matter. Exactly the quantum of credit what is available, that has to go to the actual recipient, right? So on these lines, if we understand it, in the cross-charging mechanism, it doesn't work that way. Here, in a cross-charging mechanism, we would have received the credit, let's say in 5%, 12%, 18 or 28, but whatever be the case, ultimately, when the cross-charging happens from the head office to the branch office towards the internally generated services, predominantly this service will only fall under the category of 18%. So there may be a situation where the actual credit was received at 5%, but then when it is passing through cross-charging mechanism, it gets passed at 18% for the same value, right? So this is one major difference between ISD mechanism and cross-charging in a real business that one needs to factor, right? And the last important point, having said that, the circular beautifully says in point number 1 itself that ISD is not mandatory, and then it says that it's okay if you don't follow this ISD mechanism. If only if you are registered as ISD, then you should mandatorily transfer the credit. If you are not registered, it's okay. That is what it's trying to say. But which means what? I have already, I'm already having pan India operation. I've already got multiple registrations in multiple states. I've already got an ISD registration, and I've been doing this ISD distribution categorically for the last 5-6 years. Now, can I go and surrender my ISD registration? Is it okay because now the circular says that it is optional, it's not mandatory? Now, can I go and surrender this ISD registration and then I can live peacefully without having this particular complaints? I would say the answer is no. Please don't stop with reading this particular circular. Go on to read the 50th GST Council Meeting recommendations as well. The recommendation concludes in this particular point stating that going forward, prospectively, the GST Council is going to make the ISD mechanism mandatory, right? So which means what? If you have already established a mechanism of doing this credit distribution, please do continue to do it. There is no point in discontinuing it because they have already given an indication very clearly that the ISD is going to be made mandatorily prospectively, right? So this is another important point that we need to read beyond what is given in this circular. So I hope this video would have been useful. We have touched upon various aspects of what is not mandatory and also what we need to consider as mandatory. What could be the action point from a particular taxpayer's perspective as well. And I hope the chapter-wise segregation would also have been beneficial. So stay tuned. We will have more videos coming up the way. And please keep sharing your feedback as well in the comments, right? So stay tuned with GST with Saradha. Thank you.